So the capital allowance. So normally, if the business is buying any asset, the asset will not be deductible of the revenue expenditure, means that you cannot really treat this in profit and loss account because it is because the expenditure will have an enduring benefit for the trading. So if you are buying any assets, for example, the machinery or motor vehicle, then you can receive a measure of the relief in form of the capital allowance rather than expenditure. So for capital allowance, you will meaning come across with a full type of the release, full type of the rates. One is called the annual written down rate. Another one is the annual investment allowance. The third one is the first year allowance. And the last one is the structuring of the building allowance. Actually, it sounds a little bit complicated, but you can imagine in this way means that you buying in an asset and which way you would like to make the depreciation. When you adjust this kind of a depreciation, it can help you to save more tax. For example, you are profitable this year, a huge profitable. You're gonna pay a lot of corporation tax, and you can use all this capital allowance to adjust the tax liability to make you pay less tax. Maybe for next year, there's less profits and you could allocate it less percentage into the next year. It all depending on the situation. But of course, there are some special rules. So let's see. The first one is the when we talk about the annual written down, there are two main rates. First is the general pool. The general pool, where you can get a relief of 80% per year. Majority of the machinery or the plant for the business could be being used into the business while going to this 80%. And if the business will buy the commercial property, or you're dealing with like you're buying the cars, etc., you will come across with a special pool, which is the 6% per year. You could use to deduct from the corporation tax. And if you don't want to do with the annual written down rate, you could consider about the annual investment allowance. This annual investment allowance is 100% deductible with the year. So every business which invests into the machine and any other plants can actually offset the entire cost of that plant and machinery in the first year itself. But the problem is there is a cap. It's £1 million. And it only happened from 2021 because before 2021 tax year, the cap is 200K, and it will be adjusted back to 200K after 31st of March 2023. Means that this tax year is the last tax year. The cap will be 1 million. After this tax year, it will go back to down to the 200,000 pound. So as you can see, AIA is very, very good to be used. It's very convenient because you can deduct it all in once in the first year. But the problem is there is a cap. So it's suitable for the small and medium-sized business. If you're a large company, the 1 million cap is not very suitable for you. And if you are buying the and for cars, usually you cannot use AIA, so you have to choose another one. Is the third one is a first year allowance. So for cars, usually because you cannot claim the AIA, you have to choose the FYA. This is a special provision for the cars, and it means that the director or the business owner who buys the electric electric cars or unused cars which CO2 emission is not exist 50 grams per kilometer, or any other energy saving plant and machinery, etc., you could use the first year allowance to deduct all the cost entirely from the corporation tax purchase. Yeah, your purchase. So it's 100%. But if you are, but it is only applicable for the certain things, the electric cars, and etc. etc. So yeah, the other things you need to choose whether to use AIA or the annual written down allowance. And the last one is the structuring and building allowance. This is something I don't come across in daily business yearly. We only got one client who is doing the property development who could use this allowance. So if you are a property developer, you could use this allowance with 3% per annum. But the problem is, as a developer, you cannot use this allowance for the property or property on the property you are purchase. You can only use it for the machinery or the plant you are using for the for build up the property. So that is where you need to be aware of. But I am not come across with this case more often. Only one in my hand. So. But we have a special team who can offer this advice. If you would like to discuss in further, you can contact me. I can refer you to the special team. Okay. Let's move on to the next one. The venture capitalized list scheme. Nowadays, we come across a lot of startups who need capital and use this scheme to make this business very, very attractive. So for the venture capital list scheme, there are two relief that actually you could use. One is called the Seed Enterprise Investment Scheme. Another one is the Enterprise Investment Scheme. So from the name, you can see the seed enterprise investment scheme is meaning for the startup, which is no more than 2 years. And the enterprise investment scheme is suitable for the company which operating over 2 years, but generally less than 7 years. So it is more you could use EIS, because the SEIS you could not use anymore because your operating time period is over 2 years. And what is the detailed benefit of this scheme? As I mentioned before, this is only for the benefit is for the investor rather than the company itself. It only can help the company to look very attractive in front of the investor because the investor can get 50% tax relief from the investments, and there is a lifetime cap. The cap is 150,000 for the lifetime for the business. So means that they can save up to 75,000 from the investments. Compare with SEIS. The EIS is not is less generous like SEIS. The investor can only get 30% tax relief from the investment, but the problem is the cap is 5 million. If you consider about the total amount of the investment, this 30% tax relief is very, very generous as well. Yeah. So of course, if the company want to apply for the SEIS or EIS, you need to be some certain qualifying business activity. We need to assess you before you make the application. You need to be fulfill the satisfied ongoing concern, and especially for EIS, you have to be on the growth and development of the business phase. But you do not need to worry about it because there is always a thing called advanced assurance you could apply before you apply with the you apply the scheme. So this is from the HMRC to make sure that you can get the scheme. And again, I would like to emphasize if you want to raise the capital use it through these two schemes, you have to be the company structure. Sole trader and the partnership cannot use this scheme.